guides. Will you recommend the Job Guide 360 interview guide to prospective job seekers?
Sure, I will. The guide is detailed and very comprehensive.
This is where we take a whole stack of sources, could be articles, research, maybe interview guides like today, and we boil them down to the essential knowledge you need, fast. So today's mission, we're getting into the weeds on a really complex and honestly vital role, the mortgage loan specialist, or MLS. We're using materials actually designed to train and test these specialists. So we're getting a look not just at what they do, but what they're really expected to know.
Yeah, and what's really striking about these sources is how they show the MLS role is this constant balancing act. They're essentially juggling 3 different hats.
3 hats, okay?
Yeah, think about it. They need to be a precise financial analyst, looking hard at risk. Then they have to be a super strict compliance officer, navigating all these dense regulations. And then maybe the most surprising part, they need to be a kind of patient counselor, guiding people through what's probably one of the most stressful financial things they'll ever do.
That guidance part, that sounds crucial. That really defines their mission, according to these materials. Right?
Exactly. The main goal is helping you, the client, get that financing or maybe refinance a property. It involves assessing your whole situation, checking credit, walking you through all the options, and critically, doing it all with complete transparency and making sure every I is dotted, every T crossed for regulation.
Okay, transparency and rules. Got it.
And that transparency, it really begins with the hard numbers, the analysis. We should probably jump right into the technical side first because, honestly, this is where things start. The MLS has to figure out eligibility, assess the risk. These skills are just non-negotiable.
Okay, let's unpack that. How do they actually decide if you're, a good bet for a loan? It starts with creditworthiness, I assume?
It does, but it's way more than just pulling a score. That's just the beginning.
Right.
The MLS really digs into the credit report, sure, but they're also verifying income, looking closely at employment history, scrutinizing assets, savings, and, this is a big one, they zero in on your debt-to-income ratio, your DTI.
Okay, hold on. DTI. We hear that acronym all the time. Why is that the thing? Why is it such a gatekeeper?
Well, DTI is probably the single best predictor of risk for lenders. It's simple math, really. What percentage of your gross monthly income is already going out the door for existing debt?
Like car payments, credit cards?
Exactly. Car loans, credit cards, student loans, you name it. Lenders have really specific limits for DTI. And often, even with a great credit score, if that DTI is too high, the loan just stops. So the MLS's first big job is calculating that number and then explaining it clearly so you understand your limits, not just the possibilities.
And that explanation has got to be backed by proof, right? Documents that the underwriter will accept. You can't just say you earn X amount.
Absolutely not. Verification is key. When they check income and assets, the MLS have to be incredibly rigorous. They collect that whole stack of paper or digital files now, mostly.
What kind of stuff are we talking about?
Recent pay stubs, usually 2 years of W-2s, full tax returns, bank statements off in the last couple of months, and they check everything against everything else. Consistency is vital. This whole process, it ensures you can actually afford the loan, and honestly, it's the biggest thing that prevents those awful underwriting delays later.
And I imagine it gets even trickier for some people, like the source material mentions self-employed borrowers. That sounds complicated.
Oh, yeah. It definitely adds layers. You can't just hand over a pay stub if you own your own business.
Right. So what do they need then?
For self-employed folks, the MLS needs to dig into full business tax returns, sometimes several years' worth. They'll look closely at profit and loss statements, P&Ls. They have to establish that the income is stable over time, not just a good month here or there. It means the MLS basically needs to understand small business accounting. It's like being a mini forensic accountant sometimes.
Wow, okay. So once they've got the financial picture nailed down, the MLS has to switch gears, right? Become a product expert. Because there are so many different loan types out there.
That's exactly right. Knowing the product landscape is huge. And MLS needs deep expertise, obviously in conventional loans, the standard ones, but they absolutely have to understand all the government-backed programs too.
Can you give us a quick rundown? Like, what do those different programs actually mean for someone trying to buy a house?
Sure. So take FHA loans. These are super important, especially for first-time buyers. They often allow for slightly lower credit scores and require a much smaller down payment.
Okay, that's a big deal.
Huge deal. Then you've got VA loans, fantastic benefit for veterans and active military, often zero down payment required, and generally better terms. And then there are USDA loans aimed at rural areas. Again, sometimes zero down. The real skill for the MLS isn't just listing these off, it's matching the very specific rules and benefits of each one to your unique situation, your finances, where you want to buy. Getting that match right can save you tens of thousands over the loan's life.
Okay, so this is where the job seems to take a sharp turn. You got the numbers sorted, the product picked, but now the MLS has to deal with the person. And buying a home is stressful. High anxiety seems likely.
You got it. This is where those counseling skills really kick in. It's absolutely critical. The sources hammer this point. You need a patient, educational approach for nervous clients. I mean, think about the jargon.
Oh yeah, escrow, PITI, APR. It's like another language.
Exactly. The MLS has to be a translator. Break down those dense terms into plain English. They need to lay out every single step of the process beforehand and, really importantly, set realistic expectations. Keep people updated constantly. Because silence, that just breeds panic in this process. Updates build confidence.
But confidence can get shaken, right? What happens when the news isn't good? Denials must happen. Setbacks.
They do. It's part of the job. And how the MLS handles that moment, that dictates everything about the relationship moving forward. When a loan gets denied, the first reaction has to be empathetic. But it also needs to be factual. They have to clearly explain why, based on the documents. Your DTI was too high, or your employment history was just a bit too short, or there was this recent late payment that flagged the file. Specific reasons.
And I noticed the sources say the best specialists don't stop there. They don't just deliver the bad news and walk away. They actually build a plan.
Precisely. They shift from being the gatekeeper to being an advisor. It means creating a concrete, actionable plan. Like, okay, if you focus on paying down this specific credit card, your DTI should drop enough. Or look, let's wait 60 days, get proof of that continuous employment, and then we can try again.
There was a really good example in the material, wasn't there, about that kind of personalized support.
Yeah, that case with the client whose credit score was just a little bit under the requirement. Instead of just saying no, the MLS actually walked them through specific credit counseling steps and helped them strategize which debts to pay off first.
So it wasn't instant.
No, not at all. They had to wait, I think it was 60 days. Then they verified the credit score had improved, the debts were handled, and then they reapplied successfully. Closed the loan. It just really highlights that this job isn't just about transactions. It can be genuinely advisory, aiming for the client's long-term success.
But being an advisor sometimes means asking tough questions, right? What if the information the client gives is incomplete? Or maybe it contradicts other documents?
Yeah, that's a red flag. Huge compliance risk there. Addressing inconsistencies is absolutely essential. Say the bank statements show a big deposit that nobody mentioned, or the income on the application doesn't quite line up with the W-2. The MLS has to address it, but, politely.
How do they do that without sounding accusatory?
It's about framing. They'll politely ask for clarification, request maybe an extra document. They emphasize that accuracy isn't about mistrust. It's just crucial for compliance and making sure the loan sails through underwriting later. That careful approach protects everyone, the client, the lender, everybody. So if you zoom out a bit, once the client side is managed, the MLS shifts again. Now they're like a logistical coordinator and a regulatory checkpoint. They're managing the entire flow.
And that flow is governed by rules. Endless rules, it seems. Compliance sounds like a constant battle. How do they even keep up?
It's nonstop learning, continuous training, constantly reviewing updates from the big agencies, the CFPB, the FHA, Fannie Mae, Freddie Mac.
So for someone listening, what does all that compliance stuff mean practically? How does it affect buying a house?
Well, practically it means strict timelines for disclosures. The CFPB, for instance, has very specific rules about when you absolutely must receive your loan estimate and your closing disclosure. If the MLS messes up those timelines, even by a day, the whole closing could be delayed. Weeks, potentially.
Right.
So that strict documentation, double-checking everything, it's not just bureaucratic box ticking. It builds trust that the process is fair and above board.
Okay, trust is good, but people also want things to move quickly, right? Especially with closing dates looming.
Oh, absolutely. Trustworthiness is kind of useless without speed in this game. Mortgage applications are tied to real deadlines, closing dates on purchase contracts, rate locks expiring. Managing the workload is intense.
So how do they juggle it all? Multiple applications, deadlines.
Prioritization is usually driven by the closing dates. Which deals are closest to the finish line? They rely heavily on tools these days. Detailed checklists, yes, but also robust CRM software, customer relationship management, and specialized loan origination systems, LOS. These track every document, send reminders, keeps things moving. Plus, constant proactive communication, talking to the underwriter, talking to the real estate agent. That's essential to head off any potential delays before they blow up the closing.
You mentioned the tech CRM, LOS. The sources really emphasize software skills. It sounds like an MLS almost needs to be an IT whiz, too.
Well, maybe not an IT whiz, but definitely digitally fluent. They absolutely have to be comfortable with tech. But the key thing isn't really the brand name of the software Encompass, Calyx, Point, whatever it is.
It's what the software does.
Exactly. It's the function. They need integrated systems, something to manage the loan pipeline, the LOS, something for client communication and tracking, the CRM, maybe like Salesforce. And tools like DocuSign for secure digital signatures are indispensable now. All this tech, it's about cutting down paperwork, speeding things up, and, crucially, maintaining that verifiable digital trail for compliance.
Makes sense. So tech handles the internal workflow. But the MLS still needs loans to work on. That pipeline has to come from somewhere. External relationships seem key.
Definitely. The sources talk a lot about partnerships.
Yeah, especially with realtors. Why is that relationship so critical? What does the MLS actually do for the realtor?
Realtors are often the primary source of referrals. They're on the front lines with buyers, so the MLS needs to build trust there. How? Consistent, reliable communication. And speed? Big time speed. A good MLS needs to turn around pre-approvals fast, like within hours sometimes. And they need to be accurate pre-approvals.
So the realtor knows their client can actually buy the house they're looking at.
Precisely. It helps the realtor close deals. The MLS can also share useful market updates, positioning themselves as a partner, not just someone processing a loan. Get that right, and you get a steady stream of business back from the realtor. And it's not just realtors. The MLS also has to keep a sharp eye on the actual market, interest rates, economic trends.
How do they stay informed? It changes so fast.
They have to. Subscribing to industry newsletters, tracking announcements from Fannie Mae, Freddie Mac, watching the Federal Reserve. Knowing that stuff helps them advise clients, maybe now is a good time to lock your rate, that sort of thing.
Which brings us to, I guess, the overall philosophy. MLSs have targets to hit, like any sales-related role. But the sources frame success differently, don't they?
They do. It's less about just hitting a quota of transactions. Success is framed much more around building those long-term, trust-based relationships. The real goal is client satisfaction. Because if the MLS does their job well, explains things clearly, gets the best possible loan, makes a stressful process feel manageable, that client is happy.
And happy clients talk.
Exactly. That positive experience leads directly to referrals after closing. It creates a sustainable business built on trust and good service, not just aggressive sales tactics.
Okay, so wrapping this up, what does this all really mean for you, the listener? The role of a mortgage loan specialist is clearly not just about processing forms or selling loans. It's this really complex mix. You need deep technical skill to assess financial risk. You need almost rigid adherence to complicated rules for compliance. And you need surprisingly high-level people skills to manage the very real human stress involved.
Yeah, the big takeaway for me is that the specialist is this vital bridge. They connect the incredibly complex world of finance and regulation with the very personal, very significant goal of owning a home. They're the translator, the gatekeeper, and the advisor all rolled into one, making what can be a terrifying process feel, well, hopefully, manageable. Which leaves us with a final thought for you to chew on. We've talked a lot about technology, CRM, LOS, managing digital paperwork efficiently, and we've talked about the intense need for personalized help, troubleshooting tricky credit situations, mapping out debt payoff plans. So where do you think the real core value of a mortgage loan specialist lies today? Is it more about their ability to efficiently manage that digital pipeline? Or is it more about their skill in personally untangling a client's unique, often messy financial situation? What stands out to you as the most critical skill set?